A very, very good morning to everybody. Thank you for joining us today. Um, just give us a minute, please. Checking in with the team on a quick thing. Good morning, folks. Thank you so much for joining our webinar today. We really look forward to helping you understand how supply chain financing can help unlock demand for your Kirana partners today. I would like to start this session with a quick question for the audience. Folks, if you've ever bought any product from any e-commerce marketplace uh, on loans or on EMI payments, could you please ping yes on the comments? Great. So I can see that a lot of folks here have bought stuff on credit as consumers via B2C e-commerce marketplaces, right? So the concept is that uh, any buyer who has access to credit would typically uh, buy things that they wouldn't otherwise buy, right? Say, for example, let's build on the question that I asked you, which was, have you bought something on EMI? My next question to the audience would be, would you have bought the same thing if the EMI option wasn't available? If you think so, then please ping yes on comments. If not, then please ping no. Interesting, right? So here we see a mix of answers, both yes and no, right? Which is an interesting behavior to sort of try and unpack. For people who say no, fundamentally they are using credit as a tool to unlock aspirational purchases, right? Or not necessarily essential purchases or non-essential purchases. And for people who still say yes, they typically sort of look as credit as a tool to extend their account runway, right? So typically, folks will use credit in place of debit with the understanding that they will clear off credit debts later on. Similarly, in the context of B2B, retailers have traditionally relied on their distributors and the brands that they work with for access to credit for their purchases, right? However, there are a few fundamental flaws with this informalized credit model. The fundamental flaw or the fundamental challenge is that uh, it assumes that everybody in this system has access to steady cash flows. Let me sort of build upon that particular idea a bit further, right? Suppose there is a retailer, a Kirana store owner named Shiv in Western UP. They want to buy stock for Diwali season. They are looking to stock up so that when customers walk into their store on Diwali, they have uh, enough stock in the store so that no customer walks away from the store empty-handed, right? Now, because Shiv wants to purchase more stock than usual, they might not necessarily have uh, enough cash to buy the stock that they are looking for, which is traditionally when they will sort of go to the distributor or to their brands and try to understand whether they can get a line of credit. However, the distributor that they work with, say distributor A, doesn't only have Shiv knocking on his door for this. He also has retailer B and retailer C and retailer D coming with the same request and asking for the same sort of concessions to be made for them, which really puts a significant amount of strain on the distributor. And this is not necessarily that a request that they are able to service in full, which in turn means that Shiv is unable to keep the stock volumes or the stock levels that they need to keep at their store to make sure that no consumer walks away empty-handed, right? So there is a version of this story that is playing out across all 13 million Kirana stores that exist in India, right? Majority of these folks only have access to lines of informal credit through their supply chain partners, which would be distributors or brands, or they have to rely on local traditional lines of informal credit, such as money lenders, right? But the challenge is that these terms are not necessarily in their favor. So today, as part of our webinar, we are going to talk about how we can unlock access to structured formal institutional finance for Kirana stores in India and help you superpower your growth as a brand, as a distributor, as a retailer, right? Key hit points that I would sort of highlight for you at this point in time would be that credit can unlock about 35% revenue growth per outlet for you. It can drive better on-shelf availability, which results in less sales denials for consumers. It can help you unlock faster product launches by trying to use credit as a demand driver for your new products. And it also allows you to unlock smarter and scalable GTM infrastructure. If you want to add, say, 100 retailers a day starting tomorrow, and you want to roll out financing options for all of them, this is something that you can do today with embedded credit. We will sort of, during today's session, talk about how credit, technology, and trust can come together to solve this challenge for Kirana stores, for distributors, for FMCG companies, FMCD companies at scale. I am extremely honored to be joined by three incredible speakers on today's session. Our first panelist is Prema Jaiswal. Prema is a seasoned financial services professional with over 18 years of experience. She is currently the Senior Vice President at Caspian Debt, a leading Indian NBFC focused on impact investing. Over the past 8+ years in Caspian, she has led various functions, including operations, legal compliance, digital transformation, and strategic partnerships for MSME lending. The lending book was focused on providing capital to Tier 2 and Tier 3 enterprises. Prema has played a pivotal role in building high-performing teams, launching new lending products, and implementing enterprise technology platforms. She has also overseen critical functions like reconciliations, audits, and debt recovery, contributing significantly to Caspian Debt's growth. With deep expertise in operations management, budgeting, contract negotiations, and risk governance, she serves on several key committees, including investment, audit, risk, and IT. Prema is known for her ability to drive innovation and operational excellence while maintaining a strong focus on impact and sustainability. We are so glad to have you today here with us, Prema. Thank you so much for joining us. Hi.
Thank you.
I will now move on to introducing our next panelist. Today, we are very, very happy to have Shrinivas, the co-founder and COO of Cashinvoice with us. He has over 20 years of rich experience in the supply chain finance industry. In his role at Cashinvoice, he is responsible for designing and implementing new products and steering the strategic direction for expanding Cashinvoice's footprint in India. Shrinivas has an expertise in designing new products, systems, and procedures, and contributing towards improved financial performance, productivity, and internal controls. Shrinivas was also the founding member of a leading digital invoice discounting platform called TreDs. He has also been associated with some leading financial organizations such as Axis Bank, Standard Chartered Bank, ICICI Bank, and Tata Capital. Shrinivas holds an MBA from Syracuse University and a BE in Mechanical Engineering from Pune University. We are lucky to have you with us today, Shrinivas. Thank you so much for joining.
Thank you. Pleasure being here.
Now we move on to our final panelist. We have Debdoot Banerjee from Accion. Debdoot currently serves as the Director of Product Development at Accion Global Advisory Solutions in India. After transitioning from his previous role leading digital strategy and transformation for financial service providers. In his current capacity, he spearheads the end-to-end ideation, design, and deployment of digital financial products, particularly micro savings platforms, affordable housing loans, and small business lending solutions, which are tailored to underserved customer segments. At Jana Small Finance Bank, where he held the position of head of products, Debdoot pioneered several innovative offerings: micro savings account for the financially excluded, competitively priced housing finance solution, and a data-driven business loan product for small enterprises that integrated novel evaluation techniques. Drawing on an educational foundation that includes a social impact strategy certification from the University of Pennsylvania and a postgraduate program in global business operations from the University of Delhi, Debdoot brings a strong strategic and operational mindset to product development. Debdoot, lucky to have you here with us today. Thank you so much for joining in.
Thank you. Thanks.
Great. So, without further ado, let me move on to the first set of questions. These are aimed at Debdoot and Prema. What we'd like to understand from you, Debdoot and Prema, is fundamentally what is the reality of retail credit today? What are the challenges that Kiranas are facing because of a lack of structured financing? Who do they borrow from today? And how and why does conventional lending fail them? Devdut, would you like to go first?
Sure, absolutely. And I think Akshay, you covered the context very well. Just to kind of drill down a little bit into this ecosystem, I think Kiranas themselves are a very complicated structure. It's a combination of multiple types of entities. So there are large Kirana stores, medium-sized Kirana stores, small Kirana stores, and all of them are at different points in the distribution system. So it's not necessary that all of them, have the same kind of place in the supply chain. So for example, large Kiranas would typically buy a lot of stuff online. Medium Kirana stores would typically depend upon traditional distributors. And then there are these kind of unique entities or small Kirana stores, which are at the maximum in number. They in fact go to other large Kirana stores to, get their inventory. Now, depending upon whether the purchase is online or offline or what is the type of entity, the financing also differs. I think all of us agree that there is a financing gap and there is lack of formal financing, but the type of financing again strictly depends upon the type of entity and the type of purchases that these entities do. I think what we could probably safely conclude is that the lack of formal working capital kind of financing which is needed for this purpose, that is definitely lacking. uh, which leads to another problem, which is entities take up the type of loans that they get. So small stores would take up term loans to answer to working capital needs, which would increase the real cost of lending. There could be several other challenges. For example, if they don't get formal financing, they need to depend on local money lenders, on friends and family, which again leads to unpredictability, high cost, and then there's this question of dignity, right? You need to go to the same people again and again to take money. So all of these challenges put together, I think, while there are various sources of financing, I mean, financing does exist either from the distributor or from microfinance institutions or for friends and families, or there is every market has some informal source of structure of financing. But again, there are challenges around that, and the kind of facility that probably a large business gets, that sort of facility a small business needs more but doesn't get. So that's kind of my take on this. I would love to hear Prema's thoughts.
Sorry, I think I'm audible now. Thanks. First of all, thank you, Akshay, for having me. It's pleasure to be part of this uh, discussion and I'm here to learn more than to speak. Of course, some aspects of it I will add from my own learning and the journey in this from the past 18 years. But before I go there, I just wanted to quickly also introduce Caspian, which is in the space of impact investing for over a decade right now. And in fact, we were one of the first funds in the country which were focused to support such scenarios and such kind of products in the country. We support early stage, high impact businesses today, and our goals are both social and economical. So we are a lender with a purpose, is what I would say. And we've distributed about 40 billion amount in the country till date. And for some of them, we're the first institutional lender itself, which then shows that our focus is there of impact beyond capital in the country. And recently, we're in the merger process where Black Soil will be merged with part of Black Soil, and this will help us to grow our scale of impact even further. And Black Soil, in fact, has a very strong supply chain finance program project. Which runs this and it's a growing part of their business. So I'm very excited to be part of this. That's one of the key reasons. Um, you know, but coming back to this question and Debdoot, to your inputs, absolutely. There is space for finance. There is existence of finance, and there is a lot of work that has been done in the country to provide that finance to the end customers or borrowers or Kirana stores or MSMEs. So if you just look at the last MSME Pulse data, there are about 33 lakh crore portfolios outstanding as we speak as of June 25, if I'm not wrong. But this is only on the PSL data. If you take non-PSL data, there's another 50 lakh crore that you have to add to this portfolio outstanding. And in this segment, if I go to under 1 crore segment, it should be about 24% of this, which is around 8 lakh crore. And if I drill down further to 10 lakh and below segment, then there is that falls about 36%, which will be around 3.5 crores, 3.5 lakh crores of data, which means that at a CAGR it is growing. The segment is growing at around 7 to 8% per on a 5-year CAGR basis. Now, this is with respect to applicable availability of funds. There's another aspect that we have to look at is the delinquency rate. What portion of this as a and that is where my pain point as a lender comes in, right? What portion goes bad when I lend to this segment? And some of us are aware that in the last 4 quarters, the market has been bleeding in the MSME segment, and we cannot unsee that fact right now. And again, while the blended NPAs are about 3.2%, for the under 10 lakh segment, it's about 7.6%. So that, and of course, while the more major of the lending is from the PSUs, but the NBFC sectors who are trying to foray in this market and establish themselves find it very difficult to digest this kind of delinquency numbers. And we are one of the biggest losers on this market. But that's not on the negative side. I want to bring out now on the other aspect as a financial institution what we do. Anytime when we roll out a product in the market which is very focused or strategic product, we have to first create the product, create a model, credit model around it. And we have traditional sources of data to do that today, which could be income assessment and expenses assessment, utilization, other borrowings, their repayment behavior. Basis all of this, we calculate something called a FOIR. And then this is with respect to credit assessment. Then you have to create channels of disbursements, channels of collections now, which is again an operational expense for us. And as I've always said, that lenders are not in the business of lending; they're in the business of collecting. So we have to ensure that the money also comes back so that we can lend further and have both faith in the product that we have created. And along all of this, we have to be aligned to the regulator. Okay, because there's a constant requirement of compliances to a financial institution, specifically because of the amount of money that we deal in with. But because of paucity of uh, pure and clean data, we have to use pseudo data. In fact, on my own book, a lot while we look at the credit model, a lot of the data that comes to us are the invoices of which are handwritten invoices. So there is no sanctity of this information that is coming to us. Uh, some of this are also dependent on the personal discussion that the field team is having with the end kirana store or any other MSME segment. Uh, so there could be a level of bias or there could be a level of lack of training, but both of this could lead to uh, wrong feeding of data into what we were calling out in the credit models that we have. But I'm very excited to be part of this, as I called out. How the reality which is today, which is fragmented data availability, fragmented processes availability. How can we ensure that we get into a more structured way of lending? Because Debdoot, to your point, finance is available, and we are there in the method, available to provide finance to the end customer. We just need to keep developing the structure in which the finance can be made available.
Right.
Right.
Thank you so much for that, Debdoot and Prema. So what I'm hearing is, while larger and medium-sized Kirana stores might be more savvy and have more structured operations, which make it systematically easier to have access to finance, uh, the small Kirana stores, which form the broad base of Kirana stores in India, while they have access to sources of informal credit, there's a question of dignity there, right? Am I really getting it at the terms that at terms that are fair to me? And when it comes to structured finance, they don't necessarily have the paperwork in place, right? Something that is trusted, verifiable by you as a lender, and also the fact that there is delinquency at those ticket sizes for those sort of clienteles doesn't really help, and perhaps actively, you know. Scares away financial institutions from sort of venturing actively into that segment. Is that fair?
Absolutely.
Great. Okay. Thank you so much for that, Debdoot, Prema. Really appreciate that perspective. I would, at this point in time, like to share a quick question over our audience on chat. Folks, please let us know what you think. If credit demand is real and informal sources exist, what is keeping institutional finance out of the picture? Your experiences, your perspectives, we are very, very happy to hear those. Um, Moving on to the next section. Before I do that, I see a question up on chat. Chirag, we will get to this towards the end of the session. Please don't worry, we'll get an answer for you. Moving on to the next section, let's talk about embedded supply chain finance. How do we build credit products that align with the reality of retailers today? Um, Shrinivas, Prema, throwing this up for you, right? What I'm really trying to understand is, Prema has already touched on, paper-based uh, operations. How is embedded different? What are sort of the pros and cons of both? And when it comes to embedded credit or embedded finance, how do we deal with collecting and maintaining and updating user consent data? How do we look at underwriting, given that we have to look at pseudo data or alternative sources of data? And how do we adapt our loan cycles to the working capital rhythms of retailers? Because, like we said, ticket sizes are smaller and the tenures are also considerably shorter. So, Srinivas, why don't we start with you?
Sure. I hope I'm audible to everyone. Really a pleasure to be here with all of you. So yeah, I've been fortunate to work in supply chain finance for almost 2 decades now, and I've seen the entire evolution in terms of how supply chain finance has evolved. So there've been you know phases in which the supply chain finance was actually just a replacement of the conventional finance, which was mostly document based, which evolved to a relationship-based kind of supply chain financing, where you have a larger anchor company, as we call it in supply chain finance context, and there are either the suppliers or distributors of those larger anchor companies which benefit from direct relationship with those companies. The third phase of supply chain financing that probably is something that we are currently here to discuss about, which is to the deeper tiers of supply chains, is something that could be addressed through the embedded supply chain financing. And the difference between, let's say, a conventional credit versus the embedded supply chain financing is typically that conventional credit is more dependent on documents, whereas the embedded SCF is mostly dependent on the transactions. And the way to put it is like, let's say, for a Kirana store which is buying 10,000 rupees worth of goods every week, that for a lender is a stronger signal, because of the the turnover and the cash routing, etc., is much stronger signal than their fixed income that is there on the document, which is the ethos and basic of the embedded SCF, that it is a shift from an eligibility based credit to a behavioral based credit. So that's where it is evolving as we speak. And the way to make it happen, primarily, of course, is to rely on the data points that come in from the platforms, e-commerce platforms, which have access and the credit history and everything that is there on the platform itself, but also to supplement that with some of the other data points, which are consent driven, right? So which is basically something like your credit bureau history, or the even with the account aggregator setups now to have access to the bank statements, or which supplement the requirement, with also the ability to make the payment. So that is where the role of consented data comes in, where we uh, believe in not overwhelming the retailer with a lot of documents or data requirement, but adapting to what they would have, and making credit happen through that. So the idea is that credit is not something that you would have to chase, but it has to be available when you require. So whether it is something, a point at which there is a peak demand in the season, where there is more credit that is required, and if it can be justified through the historic trends, then that period would automatically have an enhanced credit limit that would be available. And that's where I feel that some of the emerging trends, like artificial intelligence, etc., will play a amazing role going forward, which is going to solve for the financing problems for the the underserved, or the bottom of the pyramid kind of the segment, as far as supply chain finance is concerned. Prema put some great data points earlier, and everybody understands that that's been a segment where we have most under penetrated in terms of the financing. And the only way to solve that is to be able to look at it from a different lens. Some of the pointers I just gave right now, that not look at what the income tax returns are, or what the balance sheet is, and because that's not really going to serve any purpose, but look at the transaction history, and then support it with some logical data points, such as credit bureau history, and the bank statement of the business itself. So, I mean, just to sum it up, basically, we don't want to digitize the lending, but we want to basically make it, or redesign it in a manner where it is more dependent on how the pattern of selling, shopping, or restocking. Uh, that's basically the bottom line.
Great. Thank you so much for that, Srinivas. Very interesting perspective, Prema. Over to you.
Thanks, Shrinivas. Actually, it's reiterating what I was calling out in my earlier statement was that the finance is available, but there are nuances to that availability. The paucity of transparent data, the operational cost that we have to bear, which then pushes us to offer a wrong product sometimes. And as a financier to the end customer, as Debdoot was calling out some time back, where a term loan is pushed with the requirement is supply chain, or a equivalent of a ODCC facility, if at all. And of course, and the compliance, which is a real in requirement from all of us. So we've also forayed into some of the embedded financing products ourselves. And the whole idea, as pointed out by Srinivas, is that of course the relationship based of an anchor based transaction is an existing good, that it has gained ground, it has able to penetrate market and create availability of finance to certain segment of the uh, retailers and or distributors already. So one leg is crossed. Now it is the time to go to the next leg, where the availability is not um based on pure perceived risk, but it is based on the actual availability of data, and basis which the risk can be assessed. So you can leverage, as Srinivas was calling, leverage the transactional data for the credit worthiness of the end customer, and use this alternative data, feed into the models, and then predict the possibility of how much to lend, for how for how, what are the rates, what are the risks associated with it. We've done that in one of the models. I would also like to call out that this is a place where you have to segment the customer into various requirement buckets, and accordingly seek for which segment of customer what kind of data you would need. For a customer who needs a higher uh, exposure limit, we already have tradition, I mean, now we call it traditional sources of data, GST, bank statements, because the availability, and they've already created some kind of history for themselves. So that is available. But if you top that up with the transactional data of what is the purchase history, what has been the repayment history, what has been the utilization, uh, what is the frequency of purchase, has the distributor credit period actually been used up adequately, or if he's prepaying, what has been the growth of that retailer or the kirana shop vis-a-vis the distributors that he has, what kind of products is he placing in his in his shop. All of this information then adds to the to the model itself. Apart from these data models, it also, what it takes away is what I was calling out in my earlier statement again, is the possibility of an human error or human judgment. Because today when somebody walks into the shop, he sees some kind of stock, and bases his mental assessment or the training that he has been received, he assesses the stock is, let's say, about a lakh or 2 lakh. He goes to the go down, then he sees, okay, there is some more available, then let me add, okay, if he has a go down, then this, and the rate of rental would be so much. All of this information can be seeked through the available data, through the available app. So then that all adds to the benefit of a lender like us, because then, immaterial whether I'm there on the field or not, I don't need to spend a lot on the operational aspect of going to the end field with respect. The credit is coming to a lend to me on my table now. Okay, and we're also believing in believing in the data that is coming to us, because of the pure other stamping of information, that is, where is the GPS location, whether it was real, the pictures are coming in. You have, as Srinivas pointed, you're using ML to actually calibrate what is told adequately. You have transactional data which is coming on. So all of this helps, and surely helps me as a lender. We're looking for such providers of information, providers of platforms, who can help us do this real time assessment. It also takes away two other constant for me, because I've been working with supply chain for long. uh, Two key components whenever I'm lending in my head which hits is, what if the invoice that has come to me is false, or it is duplicate? So I'm not the only one who's financing this invoice. There is a possibility that somebody else is also financing this invoice, so there is over leveraging of the same data. All of these nuances do get sorted out with help of information that is transparent and readily available. to us. So I think that I'm very gung-ho about embedded financing, not just as the format of availability of finance, but also as availability of credit.
Thank you so much for that, Prema. Thank you again, Srinivas. So, what I'm hearing is looking at cash flow as a measure of worthiness for access to credit, looking at alternate data sources, and also, interestingly, what Prema mentioned, not looking at just cash flow, but also looking at their larger business context. How do they fit into the neighborhood? How do they compete with other players in the same market? Because assuming you'd be lending to the same set of retailers, all of them are your customers, and ultimately they are serving a catchment area. So very, very interesting um, view there around how embedded finance can work, and also a point that Prema made, which was how do we adapt to the different segments of Kirana stores that we want to take credit products to? How do we adapt to the realities of their business? Right. Great. Thank you so much for that, Srinivas and Prema. To the next part, again directed at the both of you. I want to sort of talk about the marketplace model versus the single lender model, right? So, marketplace, a way to verbalize a marketplace is a product for everyone. Way to verbalize the fixed lender model is a product that fits everyone, right? So, just based off of your experience, trying to understand, how does marketplace discovery stack up against fixed lender, either a single product fixed lender or the multi-product fixed lender, right? How does that look like? What are the pros and cons there, and how do we in either model match our offers or our products with the needs of the retailer, which is something that we briefly touched upon in the past two sections. If we could drill down a bit there. Srinivas, Prema, can I start with Srinivas, if that sounds good?
Yeah. So as Debdoot actually mentioned in his earlier remarks, is that there are different sizes of Kirana store. It's like, when we say Kirana store, it's not a prototype that basically applies for all kinds of Kirana stores. So there are some which could be buying majoritarily a single brand stuff. Some there could be some who could be buying smaller quantities, larger quantities. So there are different varieties of them, and hence one single lender who may have a tip, like a policy which basically wants to lend in a specific way, may not fit the requirement of all the market that exists, which is where marketplace is a very interesting approach, where marketplace essentially does three things. One is the discovery of what all are the options that are there available. Second is obviously the matching of the exact requirement of what might be required by the borrower versus what is being offered by the lender. And third is also the syncing of the cycle itself. So basically not uh, you know being a static kind of a product, rather than having a dynamic product which moves along with the trends and cyclicity of the business. So I would say, for a lack of better word, like the current flaw that is there in the distribution, credit distribution right now, is that most of this, and Akshay, you mentioned this earlier, is that most of the retailer segment is currently dependent on informal credit sources, such as either money lenders, or the distributor themselves, or the anchor themselves offering the credit that is available with them. And the need obviously is there to replace it with a formal credit, which is not only comes at a cheaper cost, but also comes at a good efficiency, and the dynamism that is required to meet the business requirements. So the an embedded supply chain finance, again going back to the same point, with a multiple credit options, basically would typically screen the profile of a borrower and present them with multiple options, Now, I mean, just taking some, real life examples from, where we operate. Let's say, there could be a buyer who would want a longer credit cycle because their stocking period are usually higher. And hence, even though the cost of financing is slightly higher, they would prefer that as an option. Whereas, there would be somebody who would, for whom the priority would be obviously the cost of lending, but that means that the cycle would be very tight, so it could be like, say, 7 to 10 days of turnover. So that's the presentment of the option, and then, the matching with the exact requirement. uh, and then also, the syncing the cycle, which I mentioned earlier, is basically something where you are able to match the business demand. Like, let's say, if there's a faster turnaround, and if I'm able to, if I, as a retailer, I'm able to pay back the loan amount sooner, then I should have that option to pay back, immediately, and have an interest rebate against that. uh, a lot of, conventional loan products have depended mostly on longer term, fixed EMI kind of business loans, which may not, perfectly fit the requirement, because what you're doing is basically creating a mismatch between the cash inflow versus outflow. uh, so that flexibility in terms of, matching the cycle is something that an embedded, finance product could offer, because, obviously, you have all the data uh, which basically, feeds into the algorithm. And so, again, I'd just like to sum it up with a point wherein, when a credit is, aligned with the exact requirement, it's tailored, or, much more discoverable. That is when, we can make it more sustainable. So that's just a closing point for me on this.
Thank you so much for that, Srinivas. Prima, over to you.
Actually, I want to go back to what you had started the webinar with, a question to the audience, that would you buy, if if you buy, would you buy it with the option of an EMI? The idea was to give a choice, right? And marketplace exactly does that. It gives the choice. It takes the choice to the hands of the borrower, which may be a kirana shop or any other MSME borrower in this segment. Okay, and the choice that they have is with respect to choose the lender that they want the money from. They might want a tier one, tier two lender. Uh, the tenor for which they want the loan for the period. Some may want depending on the product and their own understanding of their business, or or their own understanding of their own cash flows. You might be they're expecting cash flow somewhere else, and they want to pay only for limited period of credit time, and sometimes also on the choice of rates which are offered by the lenders, because some may have cost of capital is lower, so they can give you a better rate, as compared to some may think that the product that trying to purchase as a kirana shop owner, the risk in that product, or is it or it's a fast moving product, so it'll move faster in that spaces their credit model. So the whole idea is to hand over the choice to the borrower, and that is exactly what the marketplace is trying to do. Whether this model has been very successful, it's to be time tested right now, I would say. Because and a lot of effort has been going on in doing it. I mean, if you go back to how UPI is part of our lifeline now. So many of us are using, even if I don't think so, I've forgotten what a wallet is. My only wallet is my phone, right? Because and UPI Lite, for an example, there is a constant money. You don't even need a password to do that transaction. I Even if I have to buy fruits from a vendor on the on the street, I just do it, and he's accepting that, right? Which means there is acceptability of payment is already available. Um, so the uh, tool that we're using here is the M of the jam, which is, if you remember, the Trinity jam was there, and the M in the mobile that was there, that is where exactly these um, the applications that will be developed for future will be made available on these mobiles, and the penetration of mobile has been immense. I think if I was reading somewhere, the even in tier 2 cities right now it is anywhere up to 60 plus, around 75%, if I'm not wrong. Tier 3 or rural is around 60%. And both availability of networks, data, and the types of non-format phones. So there is enough and immense potential already. In fact, I was reading the comments. Some of the audience have called out saying that even if you digitize, the inefficiencies still come from the operational hazards that some of us place. So if you can create that marketplace, a clean application on that or the mobile, it becomes ease that inefficiencies will be taken away. Your and then the user, the penetration is already there. So why not use all of these choices, embed them together into a single solution, and make that as an offering to the customer, and give the choice to him. And the choice is not just to him, then the choice is also to, as a lender, it is to us, because we can choose the kind of segment of lenders that segment of kirana stores that we want to go to. We can choose the type of products. If he wants to put an invoice of, let's say, an FMCG product, I know it's a fast moving one, I would be happy to take it. But in case if he wants to run a non-essential product, I might not want to take it. Some other lender might want to take it because they know that there's better margin in that non-essential product. So then that lender also gets a lot of choice when they play along in this marketplace scenario. ULI is coming actively here. We have to wait and watch how it. I think last year when our ex RBI governor called it that he's bringing this whole UPI is established right now, and ULI is here for us all to integrate, pass on this information, and power to the end borrowers, customers, who could be both for personal consumption or for B2B transactions. So it's wait and watch scenarios, or what I would call.
Interesting. Thank you so much for that, Premani. Definitely, ULI is interesting. What the Oken team, Rishikesh Mehta and team have also been doing has been very, very interesting work, and really looking forward to how open infrastructure helps us out. So what I'm hearing is, basically, the mobiles are already there. We are already trying to piggyback off of them to sort of help with distribution, right? And the fundamental advantage to a marketplace model from a lender's perspective, or from a marketplace operator's perspective, is that you can sort of stitch together varying lenders with various risk appetites to more consistently serve a typical member of the Kirana community, right? So the likelihood of servicing their needs increases the moment I'm able to plug in multiple lenders with varying risk appetites, some for riskier things at higher rates, some for less risky things at low rates. Uh, is that a fair summary? Okay. Great. Thank you so much for that, folks. Appreciate the help. We will something that a variety of folks have already touched upon in comments. I hope this will help. Let's talk about how do we educate retailers, and how do we solve for payments from retailers to lenders, right? We'd be very happy to have Debdoot and Prema discuss this with us. So what I really want to understand, Debdoot and Prema, from your individual perspectives, right, is that how do I educate a retailer about what a credit product means for them? And typically their questions are around, what do I have to bear the cost? When do I need to make the payment by, so on and so forth, right? But only education is not, the answer. As a lender, Prema, or as a representative of a lending company, we've already sort of touched upon how we need to sync up with our loan cycles with the working capital cycles of these retailers. So how do we look at making repayment flexible to drive higher adoption, while also ensuring that our risks as lenders are managed and under under whatever benchmark we set for ourselves as lenders. So Debdoot, why don't we start with you and sort of talk about how do we go about educating retailers? I think a big question
Sure.
in the chat today. Yeah.
Sure, I think Prema's last comment in the previous section is a nice segue to what I'm going to talk about. So Accion has been working with the so-called low income, low digital maturity segment across geographies. We worked in Latin America, Africa, we worked in Asia, we worked on DPIs such as account aggregator and see how can they be adopted. So taking a slightly broader view rather than just Kirana, I think what we've typically realized is that every market, there are four quadrants, four segment of customers. One who probably will not be able to use digital products at all. It's very difficult to make them use digital products. The other who have the potential but do not have the means, which means do not have access to devices, data, and things like that. The third is who have access but are underutilizing, and the fourth is who are kind of mature in using digital data. The second and third segment are extremely important, and as Prema said, the penetration of mobile phones data has been increasing. So if you look at this is a normal curve, the normal curve has been moving rapidly towards the right, but it's very nuanced. Okay, so when we did our research on use of account aggregator, on use of even payments, what we realized is that the understanding, the agency in using digital data is still very low in a large population. So while you have data, while you have devices, you still don't use most of the apps. People use WhatsApp, but they use voice notes on WhatsApp rather than typing it. So something which is very intuitive to us, which seems like the most simple two-click, three-click solution, that becomes a big challenge. And I'll give a short example here. So while we were launching an emergency loan for a partner, which was essentially a feature phone-based emergency loan, the idea was that they have a pre-approved offer. They just send an SMS asking for money. The transaction gets authenticated, and they get money in the bank account, which is already kind of in the file, the bank account records. What we realized that even typing something like loan and 4,000 rupees, 5,000 rupees is a challenge for a large segment of customers, and we can't wish that away immediately. I'm sure it will go away. So I think the first stage is to basically to ensure that we design channels and products which are easily usable. The second point, I think a lot of the customers that we are talking about are driven by instant gratification when we look at financial products. So you can't create a program and say that you use data for a year and then something will come to you. It just doesn't click. The third is a lot of them are also driven by fear, which means that unless they know that when they need this money, they will have it, they will not take the money. So that's why these local money lenders, even if they charge, upwards of 40, 50% and even more in a month, they still get more clients coming to them as compared to, digital products. So one is, I think, you have to address all these concerns for sure. And secondly, you have to do some bit of micro segmentation. And that's kind of a balance, right? You can't also customize solutions for each specific Kirana. So you'll have to strike a balance between understanding segmentation and then designing products. Not everybody is going to be able to pay in 10 days. Not everybody will pay in 7 days. So one, how do you design products which are relevant to the cash flow? And then how do you constantly educate them? And it might seem basic, but you have to educate them on how to pay, when to pay, very clearly, or create pathways so that they don't have to make an extra effort to go and pay. So I think that figuring that out is probably the biggest challenge why such digital solutions haven't worked. On, I guess, one great thing is the platform based approach, right? I mean, where the data problem can for a large extent be solved, but again, once they take the money, they need to be told very specifically on what is the expectation. Nudges need to be provided at every moment, and you have to realize that you are dealing with a cross section of customers. Some of them have very, very limited digital maturity. So I'll keep it short.
Yeah. Thank you so much, Debdoot. Appreciate it. Interesting perspective. Over to you, Prema.
I think so rightly put. It's almost field being created, ground being created on our screens right now. Thanks, Debdoot. Yes, one is to sit in a office and design the product, and the other story is to go to the field and get the nuances and then design a product. Um, we've I as I called out in the start of the webinar also, that we've also tried to foray into this segment of embedded financing, provide option of financing to the end customer at the fingertips of the sorry f- fingertips of the mobile, uh, at access at the thumb. But it's not been an easy journey. Okay. uh, I'll take something very different as an example. Well, the education is not just about the availability of finance. I found this as a known concern, that many of the borrowers whom I was giving the loan did not even know that I existed. So they had taken a loan, there was available to a loan was available, the line was taken, they were utilizing, and then they would write a mail to me on my GRC saying, hey, listen, how is your name appearing on my CIBIL? uh, you know so, and that's, I think that's where Debut's point goes there. While they understand some aspects of what is being offered to them, they do not have the full clarity of who's the lender, what is the rate, why am I being charged, what is the credit free period. And then we had to keep explaining them to them, okay, this is the loan, this is where, and this, please, we've not done anything, because there is, of course, there's a lot of uh, other segment of fraudulent lenders of also there. And good thing is that the some of these retailers are educated enough to understand that they have to keep their bureau score clean. At least some aspects they understand that kind of energy, or they will not get more lending if they're having a wrong lender on their bureau. Those are interesting aspects that we've learned along our journey. Uh, but coming back to the question that you asked, that how can you make only not credit available but also repayment feasibility available. Some of these products that we experimented with was pure subvention. If there is any possibility that if where and specifically with the anchor led programs that we were doing, we would see if instead of passing on the credit, the bundled ROI was being passed or partially passed on, and some of them was even borne by the anchor himself. And then the anchor used to help us a lot to pass this kind of information and intelligence and education to the end retailer or the distributor, and they became the real sense anchor for us to educate that end customer. Okay. But then again, which means that there was a dependence on the anchor for us to educate the end customer. Our sending a lot of our mails and messages or SMSs were not always A, read, B, understood. So how do we keep doing that is so should we stop doing it? I think the internal call to us was no. Let's continue doing it, and eventually somebody would understand. Whenever I would step into the field, I would try and ask the retailers of whether they've understood the product, whether they've understood, and they have those apps as called out, that they said, okay, I'm not managing this, I hand it over to my son who's managing this and who's entering it. So might be the data is there, the data is not there. I'm some of them even employed CAs for themselves. I mean, so-called CAs on the grounds who are managing their khata books and other details. So it's not enough data is not there. But does it take away our responsibility that okay, the solution is not 100% being absorbed? So does it take away a responsibility? I would say no. Our responsibility as an investor, and specifically for Caspian as an impact investor, stays to keep developing this ecosystem. And eventually, like some of them have already been graduated uh, uh, to better understanding, I'm very positive that this layer 2 will also get graduated eventually, and layer 3 will become layer 2 in the near future. Okay. And then might be that this anchor based relationship lending is not needed anymore, because you have enough and more data with respect to the transactions between the two of them to take care of the credit. And as rightly pointed out by somebody again in the comment section, that they're hesitant to share their data when they start seeing the light with the token transactions or the smaller transactions. You give them a small, let's assume it's 2000, 3000 rupees kind of exposure, and then they taste the blood. There's a possibility that they will also start sharing their transactional data and grow the thin file to a thicker file, as we say in bureau language. You know, so I am very positive about this. Of course, there are mechanisms with that we've. Sorry, last 10 seconds on this. There's mechanisms how we've established this of ensuring that payment to as a lender comes through payment aggregators. Where at the end point the amount, the billed amount, which is if transacted through the POS machine or mobile application, we also embed there, so that the splitting of transaction happens. I get a percentage of the cut. uh, it can vary from 5%, 10% of every transaction, which becomes then the becomes a part of the payment that they owe to us. So eventually, and the residual portion is then collected at the frequency of whatever is the frequency of the defined frequency of the payment. So there are methods that have already been established of such nature, but education has to continue, and we have to keep ensuring that we let these smaller products program at a program level or a project level through whatever means out in the market, so that we keep educating the end customer.
Thank you so much for that, Prema. Really appreciate it. So what I'm hearing is key. There's a big onus on lenders and people designing the products, these platforms for Kiranas to really cover the gap between the expectations that an urban consumer has and that a Kirana store owner in upcountry India has, right? What we think is easy from a user experience point of view is clearly not intuitive for them. What we think is standard from a lending tenure, repayment cycle, compliance load perspective isn't necessarily simplistic or obvious to these folks. So a lot of the onus falls on marketplace operators, on lenders to sort of walk the talk and cover this distance because we have all the muscle. They don't. They're the ones looking for help here. So that brings us to the end of our session per se. Thank you so much, Prema. Thank you, Debdoot. Uh, thank you, uh, thank you so much for your points of view. Also, if we can have him back on the screen, thank you so much, Shrinivas. Now, I know we are already a bit over time. I would quickly like to transition into questions asked by the audience. A lot of questions. The first question came to us at about 10:18 a.m., so almost an hour ago, was from Chirag Bansal. This question is directed at Prema. What's your view on supply chain financing in the agrochemical industry?
Um, and interesting is that because we're doing a program of such project of that nature, not purely chemical, but in the agro supplying of um, so we've tied up with a company called Balwan Kisan, which caters to the needs of the farmers on FPOs, and it could be threshers, it could be pesticides, it could be any deal. And here, through the line of retailers, because they are the distributors, and so they are the manufacturers and directly supply to the retailers. We are providing a line of credit to the end retailer, and basis the purchase history that they have had with Balwan Kisan as an example. So, to answer Chirag to your question, there is availability of such lines. We just have to find the right lender and who are ready to take this as a product, onboard their product. So Caspian understands agri it because it's been a specialization sector for long. So that's why it was easy for us to develop a product tie it to a manufacturer like Balwan Kisan, and then away, and any product that Balwan Kisan today does, is made available to the end retailer and through the BNPL product that we've offered to the end customer. Of course, sorry, but this is an anchor-led product today. We've still not gone to the pure open market product, but at least I'm happy that we've done something there. I'm also, as a wholesale lender, I'm aware that there are other companies that we've lent to directly, who are then providing, because of pure manufacturing, they're passing on the credit uh, lines, or they're passing on the benefits of the lower capital, low cost capital available to them, to the end customer, in both through supply chain. So what we're working is directly or indirectly.
Okay. I'm going to sort of skip the queue a bit because you already sort of hinted at this question in the last section. So we have Sachin asking, or rather suggesting, a typical distributor supplies to 200 to 300 Kirana stores who buy on short-term credit. Would it be prudent to provide credit line to distributor? It reduces risk to one instead of 200 entities. Distributor has reliable and organized data. Now, this is not quite anchor led, but this is sort of what I think he's saying is, can we use distributors to distribute credit as well, right? So right now they are sort of distributing informal credit on their books. Can we instead provide them a way to distribute formal credit to their retailers, taking away some of the stress of figuring out how do we take our credit products to market for a particular company, for a particular catchment, for a particular distributor?
Yeah, so let me take this. So the what in my experience, of course, this is actually a lot more established approach. And if we actually see the Western markets where the supply chain finance is a far more evolved product than where how it is in India, this is typically the approach that you rely on a large size distributor and factor their receivables. So factoring as a product is very popular there, wherein it's akin to financing, but also gives a balance sheet advantage in terms of not putting too much of a debt on your balance sheet. So there are global examples that are available that would actually justify doing it this way rather than having to rely on information coming in from smaller kirana. Where I have seen personally the challenge is that distributors capability of taking additional burden on their balance sheet is limited, because they typically also have to pay in advance to the anchor companies when they buy the goods from them, which basically creates a debt on their balance sheet. So to add on to that, if you also start taking the entire credit risk of the collection as well on the balance sheet becomes quite leveraged. So of course, there are, like I said, there are answers like factoring where uh, that could solve for the problem, but a lot of this is also dependent, and sorry to digress a bit, is that also depends on the lender's ability to take risk on how much risk they can take on a particular transaction. And unfortunately, in India, there is lack of credit insurance infrastructure in an abundant manner as it is in some of the other economies, which would have enhanced the lenders' capability. Although there are like new guidelines of IRDA which are floated about few years ago, there not been as much of an offtake of a credit insurance in the Indian market, and that could possibly open up the doors to structure a product that Sachin, you have just pointed out here in your question.
Very interesting. I think somebody on this call is going to come out with a product very soon. Interesting. I think the next question aimed at Debdoot is something he has already covered over chat. Chirag, the question directed at Debdoot, he's responded over chat. Please have a look. Moving on to Chirag's next question. In many cases, retailers prefer taking credit from distributors, even if it's built on informal relationships.
We lost Akshay, I guess. Somewhere. So I guess the question that he was referring to was this: in many cases, retailers prefer taking credit from distributors, even if it's built into the product pricing, rather than opting for financing from NBFCs or money lenders, where interest rates are significantly higher. Given that FMCG margins are already very thin, how do you view this behavior? What are the key factors driving this preference, and how can the formal credit solutions be made more attractive or viable for retailers in this segment? Debdoot, you want to give a swipe at or Prema, whoever prefers.
Yeah, sure. I think it's the same concept as embedded finance, right? I mean, it's actually convenient and it's just fit to the usage at that point in time. And it's easier for the retailer to deal with one person than multiple people. The challenge, though, is from the distributor's part, it becomes an additional, work of following up, getting the payments, and all of that. So it's not going to go away. But if a distributor is lending, that's a great option. The challenge with the distributor lending is that does it close out options for the retailer in that sense? Does he have to pick up high-priced item? Does he have to go to a limited number of retailers? Does it prevent him from buying online? So those are the challenges that we are sorting for. Also, distributor credit is available to retailers who have been in transaction or who have a relationship with the distributor for a fairly long time, right? When there's that trust evolved. What happens to a smaller or a new retailer? So that's I think where these other forms of financing are very relevant.
Yeah. Prema, you want to add anything to that? What just Debdoot said? I'll just, uh, take this opportunity to get some hosting experience.
You're doing a great job with it.
Great, thanks. Um, as Devdut already pointed out, the interesting aspects of it, that the distributor credit, of course, it could be in the form of a credit period or financing, either of it. Gives is something where the um, it is dependent on the distributor and his assessment of the retailer. Tomorrow there is a tiff between the two of you, and that whole line is vanished. As compared, and that tiff may not just be because of non-payment. It could be for any other reason. It could be a market force. Some of the financiers who are sitting 100 miles away from you are not looking at the tiff as an example, because they're purely getting guided by your ability of credit and ability of repayment. Uh, s- and also, as part of growth, sometimes it is important to for the retailer to get attached to formal line of credit, because eventually that is where the growth is. You might be attached to multiple distributors today. Some distributor is offering you a line and the other is not. How do you tackle that kind of scenario? And that is where the marketplace that we were talking about some time back, where your ability to borrow uh, gets expanded multifold. I think, of course, and this goes back to the last question that Akshay was asking. How do you educate?
Yeah.
Eventually, all of us today, if we want to borrow money and in our stages ourselves, we always go to a formal channel. Of course, we do more. It could be just pure. I would never take a home loan from the 2% charger. I would always go to a bank and compare banks and see which one wants to give me. So that means that we've already upgraded ourselves. Eventually, there is a possibility also that the retailer will come forward, and you have to keep educating them, saving them from the sharks. Uh, you know, but eventually, that's the path.
Thank you so much for that, Prema. I will
Thank
quickly
you.
move on.
He took your part some time back.
Oh, excellent. Thank you so much. I'll move on quickly to the next question. The distributors, and this is from Himanshu Chattar, the distributors do not want to get into channel financing. They find delaying payments to the brand much easier than to get into channel financing. What are the bait options to make it lucrative for them? How to bring them out of their comfort zones, especially in FMCG products like oils, shampoos, talcs, etc., where price and credit is considered to be a moat. Before I throw this up for the larger audience, for our panelists today, I just want to point out a lot of this is a function of how much leverage a brand has with its distributors. Smaller brands typically don't have this leverage. Larger brands will have this leverage. So there is that angle to it. Over to you, folks. What do you think?
So let me go first. So what I have seen again, in my personal experience is that obviously there is always a trade credit discount that is available within the any trade transaction. So between an anchor and a distributor, there are two kinds of payment terms. One that basically incentivizes them for an upfront payment, and the other is where you get a credit period, which is so let's say you either pay 98 rupees against a 100 rupee invoice on day one, or you pay 100 rupees after day 30. The question for financing or any other credit line replacing this comes in where the cost of the credit is lower than the discount that is being offered by the anchor for an upfront payment. And this applies to almost all the industries, maybe the larger industries like automobile, etc., they've already moved on that there is absolutely no chance of you having any credit at all, and you have to do a cash in credit. But in most of the other industries, in FMCG especially, there is an inherent credit discount that is available. So that's where I feel the products need to be designed in such a manner where a retailer or a distributor, basically, I mean, whoever is the buyer of the product, uh, sees that as an arbitrage opportunity, that if they borrow at 12% but they're getting a discount at 18% for an upfront payment, they're more likely to take it. And that's how basically the anchors can also deleverage their balance sheet, or they can reduce their account receivables to that effect.
Great. Unless somebody else wants to add something, I think we will close the Q&A section. I think there is another question by Siva around rates of formal and informal credit lending in the market. Siva, our team will be happy to sort of cover this offline over email. Thank you so much for posting this question. I would like to first off thank you, our panelists, again for taking time out and sort of covering this topic with us. I'll quickly sort of summarize what I took away from our conversation today. So Prema talked about how we need to move to essentially data-backed credit models that don't just look at sources of traditional data to power credit for the product for the customer segment that we're looking at, Kirana stores. And she also talked about how embedded finance isn't just about availability; it is also about structuring credit, making it transparent, and making it discoverable. And what stuck with me the most, because it resonated with me, was that uh, looking at ways as a lender to empower my borrower and service them better. Right. So thank you so much, Prema. Interesting views. Debdoot talked about how the need of access to credit is very nuanced for kiranas. Different segments have different needs, different buying behaviors, and the options that they have today and traditional options have typically technically been at the cost of their dignity, but still something that works because there is a clear demand. Perhaps a part of that demand is not being met because we are designing products which are not relevant for the Kirana store users or are not usable by Kirana store users, right? So maybe we have a tooling or a platform problem, and we need to essentially look at how does educating the Kirana store owner and how does surfacing data from the Kirana store's operations work in lockstep. for both lenders and kiranas to actively and meaningfully work with each other. Right. Moving on to Shrinivas. Shrinivas talked about how they have increasingly moved from relationship-based data like GST, banking details, etc., to more behavioral data. What does cash flow look like? What is he buying? What is he selling? So on and so forth. So not just looking at gates for eligibility, but trying to really understand the person's business to give them the right credit product. He also talked about how fundamentally, the I think strongest advocate for marketplace lending here today on the panel, that fundamentally a marketplace model allows for dynamic matching of products to customers, which is always great for the customer, right? I think everybody can agree with that statement. And the last bit was around, how it is not just about access to credit today. It is about alignment to the customer's needs today and tomorrow. How do I match, or how do I create a product that really works for my customer, right? And doesn't necessarily result in delinquencies for me as a lender. Thank you so much again, Debdoot, Shrinivas, Prema. Very, very interesting perspectives. It was a pleasure and an honor to speak with you folks today. And folks, if you have any other questions for our panelists, please write to us. Aftab can share the email ID on chat, and we'll be happy to redirect your questions, make introductions as necessary. Thank you so much, Debdoot. Thanks, Prema. Thanks, Shrinivas. Have a great day.
Thank you.
Pleasure.
Thank you.
Cheers.